it's concerning to me. It just builds on the fact that I believe the expansionary period in the U.S. is over for now. I look at like our productivity; it's lower. I mean, it's not getting any better. You combine that with wage inflation, I think it spells trouble for our market and something a lot of people aren't speaking about. We continue in the S&P 500 to stay around this 2100 level. With multiples as high as they are, I really do think we're going to have trouble in the second half of 2015.
The month of May certainly seemed to be categorised by the weakest volumes this year, very thin liquidity, low conviction. It seems that June is off to a very similar start. Do you think more of the same is expected?
Yeah, I do think it's more of the same. And, you know, just so much of it, we have this Greek noise that's just deafening to us. And today we saw some dramatic moves in the dollar. Bonds just fell off the map. We have the German Bund up at 72 basis points. I mean, who would have ever thought that? 52-week highs. So I think it's going to continue. I mean, I do though think we're going to need a good old-fashioned Fed scare, because I don't think the equity market here in the U.S. is fully reconciled to the fact that the Fed is going to raise rates, and probably sooner than later.
Larry, Mark Todd here from the NAB. I was interested to hear what you said about the wages piece, because I think there's in the services sector there's been some wages growth, but that's the only sector that I'm aware of. Maybe there's more. But one of the things I think is the challenge that the US market hasn't come to grips with is the reality that corporate America has given back a lot of the money in the form of share buybacks in dividends, and they haven't spent money on their businesses. So I think productivity is the thing that's really going to crush them, because the only way to get more output is to pay people. And because they haven't spent on their business, they can only pay people. So it's either services have definitely gone up a little bit, but it's still mute. It's still small.
Sure.
But I think if you look into the future, they're underinvested, and that's the problem. That's the canary in the coal mine.
You know, Mark, it's a great point, and I do agree with that. To a point. I mean, I do think they've had a chance to build productivity, but I think they were depending on wages being as low. They have crept up across the board, but you're right, service sector more than anything else. I just think when you combine this with the multiples of 18 times for the S&P 500, there's not a whole lot of room for insulation. I mean, if the stock market was trading at 15.5 or 16 times multiple, I would feel a lot better about it. I'd feel more constructive. Right now, I'm cautious because I think there's just too many things in the way for a down move than there would be for an up move.
So I've been describing this as the greatest game of musical chairs we're ever likely to see, and we're looking for somebody to turn the music off. And do you think Greece is the musician at the moment? Do you think they're the ones that control what's going to happen for that exit strategy?
You know, I really don't think so. And maybe I'm just over comatose with all the noise, the headlines that I read every morning about Greece. I mean, obviously, it's a risk, and it's a real risk. But when it comes to all the headline risk, beneath the surface, I do think it's going to be okay. And I don't think that's the cause of liftoff for the Fed or anybody else for that matter.
When are you calling the Fed to lift? When do you think it lifts? I mean, most people move it out to September. Where are you?
I'm still September. About a month ago on Sky, I changed from June to September. I just threw my hands up. But I will say that, you know, we have unemployment coming out this Friday. If it runs hotter than 250, I think there might be some pressure for June or July. I tend to be a little bit ahead of the market. Fed futures have rallied to the point where they're now implying a 47% chance of a September hike. Just 2 days ago, it was 39%. So it gives me a little bit of breathing room.
Larry, if we saw the Fed coming out and explicitly saying we're going to hike rates in September, what impact do you think this would likely have on markets? Do you think inevitably that would cause some dislocation?
Yeah, I do believe so. I think the S&P 500 would drop about 50 points down that 2050 area. Not enough to start like a bear market or anything like that, but there will be a Fed scare, because right now, as I've said, the market doesn't seem reconciled that there will be a rate hike. And the rate hike does not have to be bad. It could be a symbolic thing, and we can handle that in the economy. But I do think there will be a scare, and we'll see ourselves down around 2050, which is about 58 points lower than we are today.
Larry, the way we've been trying to look at it has been that not so much the timing, but the question of how they're going to rate hike. It's not a question of...
Yes,
so
yes.
I think that's the greater key. You know, do they use the repo market and then all the coupons they're getting from existing long-dated bonds, they'll use to buy long-dated bonds, so they'll buy that curve to try and keep that curve down, because I've been following the mortgage rate in the US, and clearly the long-dated mortgage rates are going up, and that's not what the Fed wants to see. So do you think it's more about how they explain how they're going to lift these rates rather than the timing of it?
Yeah. Yes. Yeah, we should switch seats. I mean, we don't hear about this in America too often, but it is about, we should switch places. I mean, it's about the timing of it all. I mean, the 25 basis points, leave it alone. They don't have to raise rates again until they look at more data to see. There's no problem with a symbolic rate hike, and I think the market just is out of kilter about the whole thing. And you're right, the long end of the curve is not acting in a way that makes the Fed feel very good right now, either is the short end for that matter.
Larry, the dollar's underlying valuation seems to have returned to tempt fate or the Fed again. Do you think we need to see the Fed delivering that September rate hike to justify the dollar's recent revival?
Yeah, absolutely, except for what happened today to the dollar. But it has a valuation problem. I mean, the dollar index rallied quite a bit, maybe almost close to 5%, very silently in the month of May, based on really nothing, maybe the long rate a little bit. But when you look at dollar rates currently, excluding what happened today, you would think that there's been like a 50 basis point rate hike. That's what it's implying right now. So, the dollar definitely has some room to come down, and it did so today. And, you know, I'm still long-term bullish for other reasons for the dollar, but it definitely is, you know, it's got a valuation problem, and it's way ahead, as much as the stock market is behind, of a Fed rate hike.
Larry, just finally taking a look at the broader market, what's your expectation in terms of whether this rally is sustainable? I mean, we know there are low volumes, low volatility at the moment, but those markets are still trading at these relatively high levels. So what's your view in terms of whether the rally can be sustained?
You know, I can see the market or the equity market sustaining itself, although I am bearish right now. There's too many headwinds that we're not talking about, but it can definitely sustain itself, because you hit the nail on the head. I mean, it's relatively high, but it's really not high relative to other asset classes, because all asset classes are high right now, relatively speaking, except for government bonds. So I do think it can. I wouldn't be invested in U.S. equities. I'd be underweight, and I'd still be overweight European equities and also Japan behind that. But U.S. would be a sharp third place, and there will definitely be pockets, especially in the banking sector. I think that's still a good long-term play in America. But for now, expansion is over. I don't think we're going into recession, but I think you're taking a lot of risk in the U.S. market compared to the reward.
So at what point would you look to go short on some of those risky assets?
You know, I guess not being long, or not being as long as I would be, is actually being short, because I'm not taking advantage of any upside. So I just think if multiples go any higher than they are now, I would be short the U.S. stock market, just thinking that we're not seeing the economic numbers carry the weight right now, and the multiples don't earn or don't deserve the spot that they have. So multiples go any higher than we are now. 2175 in the S&P 500, I would go short.